Hi, my name is Ron Wilstein, and I'm a broker at Keller Williams Luxury Homes in Park City, Utah.
And my name is Ed Knapp. I'm part of the Wilstein team.
Thank you for joining us on this webinar as we deal with the topic of how to use your self-directed IRA or IRA to purchase real estate.
This is really good information, so stay tuned.
Before we get started, I want to introduce you to Ed. Some of you are familiar with him from other webinars that we've hosted. Ed brings a great deal of experience for this particular topic, and so he's going to be the main presenter here today. Ed's experience includes 15 years in real estate as a broker in the Southern California marketplace, where he invested in both single-family homes as well as investment rental properties, apartments, and land. He also had a Series 7 license as a financial advisor, worked for one of the top 10 Wall Street firms for well over 10 years. And he owns real estate investments in the Park City area. He's engaged in 1031 tax-deferred exchanges, and he just likes to invest in real estate, and he utilizes the very strategy that we're going to talk about today, the self-directed IRA, to purchase real estate.
Well, thanks for the kind words, Ron. For those of you that don't know Ron, he is the most knowledgeable and trustworthy broker I know, and I've been dealing with him for decades.
Well, thank you.
Thank you, Ron.
All right, well, let's get right into our topic here. We'll start with an overview. Ed, why don't you share what we're going to cover here?
So you can set up a self-directed IRA or a Roth IRA, either one, to invest in real estate and or trust deed notes secured by real estate or even other allowable investments. And this can add diversification to your investment portfolio, and you can profit from the real estate cycle as the economy grows. And also, you need to only use a portion of your IRA funds to invest. You don't have to invest all your funds.
All right, so you can keep it diversified through other...
Absolutely.
All right, great. As with everything, there's a caution here.
Yeah, realtors are trained in the marketing and sale of real estate, and we do not provide clients with any investment guidance, financial planning services, legal consultation, and tax advice. Always consult your financial professionals.
And of course, we have to include a disclaimer letting you know that is not our area of expertise, and there are folks out there, attorneys, self-directed IRA providers, and other CPAs who can help you out. So we just want to pound that out to you before we get into our content.
Absolutely. Always work with those people.
Yes.
So let's talk about the 4 ways that we have most of our clients buy real estate, especially up here in Park City. And the first would be just straight cash, and that would be on the taxable side of your account. The second one is to use a cash and financing combination, which is probably the most common way that most of us have bought real estate. We use some cash as a down payment, and then we get financing with a loan. There's another way that we also do it, and that's with 1031 tax-deferred exchanges. Ron, we've done some other webinars on that, and we're very knowledgeable on that. We'd be happy to help you investigate that further. And then finally, today's topic, using your regular IRA as a self-directed IRA to buy real estate.
So let's take a look at how these two tie together.
Yes, a little known secret allows you to use your IRA to invest in real estate. Most people believe that their only IRA investment choices are CDs and the stock market. Most of us have those types of accounts. But using your IRA, you can invest in real estate, and we'd like to show you how today. IRA investments allow tax-deferred or even tax-free profits using Roth IRAs, and we're going to share those secrets with you in just a minute. So let's talk primarily first, Ron, about the steps to creating a self-directed IRA. You may be watching this presentation and asking yourself, or maybe you've read about it, let's go over what we consider the 6 steps to finding that out. The first thing we'd like you to do is consult with your CPA Tax Attorney, a qualified financial advisor, for viability. The second thing you'd want to do is determine if you have eligible IRA assets to transfer into a self-directed IRA or a Roth IRA. And most of us, Ron, do. Actually, most of us do. And then we would want you to find an acceptable self-directed IRA custodian. These are the people that actually administer your self-directed IRA. A great place for that referral is through your CPA. Number 4 is carefully transfer your cash assets into your new self-directed IRA or Roth IRA. There are some rules, and again, we can help you understand those. The next thing you want to do is identify your investment vehicle, whether it's going to be real estate, notes, trust deeds, and so on, and actually execute the purchase of those items. And then finally, we would want you to monitor your investments with your CPA and self-directed IRA provider.
Yeah.
It's really quite simple. Right?
Okay.
Just
Yeah, those steps are very easy to understand and grasp. So let's jump into this. Talk about what's allowed when it comes to this sort of IRA investment.
Let's talk to the issue of what you can actually buy in a self-directed IRA. And right at the top of the list is single-family investment homes. You can also buy apartments, duplexes, land, commercial real estate. You can also hold mortgages, deeds of trust, and promissory notes. You can also go after tax lien certificates, private limited partnerships, and private placements, and even equipment leasing and other investments. But we're primarily concerned with the top three that are in this slide here, Ron.
Yes.
Okay.
Now, that with everything, there's a caution that our IRS gives us, and they're set forth by the Internal Revenue Service, and you don't want to jeopardize your tax-deferred status on any account because it could lead to disqualifying the benefits that you're seeking to get.
And again, we think you can mitigate that greatly just by working with your proper financial advisors, especially your CPA or tax attorney.
Yep.
So let's discuss possible funding sources. Where do you get the money to transfer into a specific pot or a self-directed IRA? And most of us, again, have an IRA or a Roth IRA. If you've been self-employed over the years, you might have a SEP IRA. If you've been working with somebody else and or own a small business, you might have a simple IRA. If you work for a large corporation or a nonprofit or whatever, you may have a 401k, a 403b, and or a 457 plan. And again, we just mentioned the IRS publications and consult with your CPA. But these would be the funding sources that you'd want to ask your accountant to go over with to see what you can actually use to fund up your self-directed IRA.
Excellent. Now, what can you not do within a self-directed IRA?
Well, there's certain things, and it basically comes back to common sense and the arm's length rule. So basically, you can't buy property for your own personal use for either present or future use, but there is a Roth IRA workaround we're going to talk about in a minute. You can't borrow money from your self-directed IRA and use it for yourself. And you can't be selling your own properties into your IRA. And again, these are all arm's length transactions that common sense would tell us we can't do. You can also not use your self-directed IRA as security for a loan. You can't pledge that as an asset in order to borrow money. And you can't receive unreasonable compensation for managing your self-directed IRA, which we're going to talk about further in the next few slides.
All right.
Okay.
Now, we've often heard the expression self-dealing in association with this type of investing. What does that mean, Ed?
Self-dealing means, again, that you're staying at arm's length. And there's certain people and certain properties that you can't do inside of a self-directed IRA. So disqualified persons include fiduciaries, which would be you. You can't be lending yourself money out of your IRA. And then there's certain family members, and there's a list we can go over with your CPA, spouses, parents, children, spouses, and great and grands, and so on. And those people, you can't be doing what's called self-dealing, because this account is primarily for business purposes. And then service providers of the self-directed IRA. So you don't want to be doing business with your CPA, your accountant, and or your IRA provider, because they're not at arm's length. And certain entities that you might have an interest with, if you have a position with a corporation or you own a large number of outstanding stock of a corporation, again, that would be self-dealing. And if in doubt, you just check it out, call your accountant, and we can be on that call with you to make sure that you're not doing anything wrong.
Excellent. Good advice. Again, just don't want to jeopardize this opportunity.
Yeah, sure.
There are some other important rules, and if you just go through those with us, Ed.
Well, yeah, and these lead on or layer on over what we've already talked about. The self-directed IRA cannot buy property owned by you currently or a disqualified person, such as your CPA or your son. You can't do that. Special title documents have to have the words "for the benefit of" wording, and that you might be familiar with already. If you look at your stock account, it usually says "for the benefit of" and then your name. You can't have an indirect benefit, so we can't use it to buy a vacation home up here in Park City. But if you remember the opening slides we had, you may be able to do it in other ways, then we can help you figure those things out. And partnerships and undivided interests are okay. You can invest in partnerships and undivided interests. And again, our CPAs and our tax attorneys can tell us what those are.
Okay.
And if you use financing, there's a thing called the unrelated business income tax, and that's that UBIT acronym, might be due on a yearly basis. And we're going to talk about that in a minute in greater detail. And real estate expenses must be paid from your self-directed IRA, and income must be returned to your self-directed IRA. Let's keep this simple, Ron, and say that if you have to pay property taxes or management fees, those funds have to be paid out of your IRA, and your self-directed provider will do that for you. On the other side, on the income side, if you receive income or any other type of remuneration, that has to go back into the account. So it just basically means coming and going, you use your self-directed IRA.
Just got to treat it separate from your personal business account.
Exactly, right.
Okay.
You wouldn't be writing that out of a checkbook.
No, for sure. Well, let's talk about the advantages and disadvantages. There's always two sides to this coin, and we'll start with the advantages.
Yes, like we say, there's two sides to every pancake. Okay, so your capital gains and income tax are deferred and may be tax exempt for Roth IRAs. And most of you are familiar with this. If you have a 401k now where you have stocks and bonds, that those profits will not be taxable until withdrawal. And you can diversify your IRA among stocks, bonds, mutual funds, cash, and now the way we're showing you, you can also add real estate. What a great way to diversify your portfolio. And you can take advantage of our depressed but now recovering real estate market. We think we have many innings left in this game. What a great time to invest in real estate. You get to direct your retirement investments instead of sitting by helplessly on the sidelines and watch what happens with your retirement funds. So you can be much more active in actually investing in perhaps real estate if you're very, very, very familiar with it.
I think that's one of the things some of my clients have liked the best, that they feel they're in control of their future retirement a bit more than some of the more conventional ways.
Absolutely. You don't have to deal directly with Wall Street on all of your investments.
Yep.
Let's talk about some disadvantages of self-directed IRAs, Ron.
Okay.
You need to designate some of the funds as your cash reserve for expenses. And we've talked about this. So you can't use all of your IRA funds to just buy the property, because you have to still administer it, take care of capital improvements and expenses. So for instance, there may be a percentage of the account that you leave in cash to actually administer the property. And sorry, there's no depreciation that you can take on your current 1040. However, remember, there's no recapture of depreciation at the back side of this when you go to actually start taking money out of your self-directed IRA. So it's a plus and a minus. They kind of cancel each other out. Your role is limited in property management. This doesn't mean that you can't be involved. It means you can't pay yourself as a manager. And leveraging and mortgages are more difficult and expensive and subject to that unrelated business income tax we talked about earlier. So a lot of times it makes more sense just to use straight cash for a self-directed IRA.
Okay.
Great. There's a few more things we want to talk about. You may be subject to liability exposure, and this can be easily solved with insurance policies through your real estate agent. And the profits are subject to typical IRA distribution tax rules, just like your 401k would be at retirement. And family and company beneficiaries are not allowed to participate in these IRAs because they're not at arm's length. And again, that's just common sense. And an analysis may indicate that using a 1031, tax-deferred exchange, or simply paying the taxes may be better for you. And do the analysis first. And oftentimes, we're involved with clients and their CPAs in a discussion on what's the best way for you to do this.
That's right. You always got to consider your options and not just get fixated on one choice.
Exactly, Ron.
So best ideas for self-directed IRAs may include?
Yeah, let's talk about some of the best ways. Buying raw land to improve and or subdivide and sell is the real sweet spot, in our opinion, of using self-directed IRAs. I do this myself. It's absolutely fantastic. And you can buy homes for cash And remember, there's no depreciation for tax write-offs in the taxable year, but all your profit and the buys and sells are not subject to capital gains while you're moving in and out of these investments, because it's just not taxable until you start taking the distributions at a later date in retirement. So that makes it perfect to buy and flip properties, whether they're land, whether they're apartment buildings or single-family houses or even commercial buildings. You're not going to pay taxes. You're not going to pay short-term capital gains tax. Everything gets deferred until the end. And you can also buy long-term triple net leases. That's allowable under a self-directed IRA.
All right, lots of good choices there.
Absolutely. So one of the other things you can do is you can also create an LLC. Now, this typically, a limited liability corporation, this would typically be involved for those of you that are dealing with larger properties, commercial properties, and also apartment buildings that are rather large, 16 units and above. So for some of us smaller investors, we wouldn't spend the money of $2,000 to $5,000 to set this up. We would just do it straight up in our self-directed IRA. And then, Ron, you had asked me earlier about investing in promissory notes and deeds of trust. You can work both sides of this transaction. In other words, you can lend money out as a trust deed holder and collect way more interest than you're going to in a CD right now. CDs are paying about, as we do this seminar, they're paying about 0.5% interest in a CD. Wouldn't you like to get 5, 7, or even 10% interest on a trust deed that you lend out your money inside of your self-directed IRA? Additionally, you could buy notes at discount. So if somebody has a note that they want to sell and turn it into cash, you might offer them a discount, and you win two ways. You win on the discount, so you pay them 80 cents on the dollar, and then you also collect the interest on that way better than CDs.
Yep.
Also, you may be able to buy your future retirement home in a Roth IRA before you turn 59 and a half, and then distribute it later under the rules allowable under the Roth IRA.
All right, lots of good ideas there.
Absolutely fantastic. And then typically we have to give you our warning. Investing in IRAs requires close attention to the IRS rules and regulations, and violating these rules can trigger a serious taxable event, and you don't want to do that. So again, all we ask is that you consult with your appropriate financial advisors.
Excellent. Well, we've tried to summarize the essence of the self-directed IRA to buy real estate, but if you've got questions, feel free to send us a quick note or question by email at ed@thewilsteinteam.com or myself, Ron, at thewilsteinteam.com, or call us on our toll-free number, 800-535-0151. We're here to help and to assist you in any way that we can.
Yeah, we'd love to get an email just asking a question about what possibly you should do, because there's many ways to solve these problems.
That's right. And then just as we conclude, we want to thank you for participating and remind you that every month we do a Park City Market Update webinar. You can go to our website, viewparkcityrealestate.com, and we update them on the second Tuesday of the month. So they're always very current, giving you a great snapshot of what's happening in the market, as well as we address relevant topics for the time.
Great, and that's it. I want to wish all of you the best wishes, and if there's a way we can help you move or buy property up here in Park City, just let us know. There's a lot of different ways to do it.
Thank you.
Good night.